Throughout the history of the US stock market, we have seen many times when the market dropped like 40%, 50%, and even 90% during the 1929 Great Depression. But every time this happened, was it the end of the US stock market like so many people feared? No. So far, every single time, the market has always recovered, and it actually has made higher highs than it did before. Now, more than 70% of the time, the US market as a whole has had a positive year, and the average yearly return on the US market is around 11%. In this video, we're going to discuss why. Why is it that the US market so far has always recovered, and why is it that it is continuing to grow over time? Firstly, the United States is the largest economy in the world, with a GDP of around $20 trillion as of 2022. Along with that, the United States also has a massive population of around 330 million people as of 2022. A large economy means that US businesses operate in a huge market and have plenty of opportunities to thrive and grow. Why does market size matter? Let's think about it using this analogy. If we take the largest online retail company that operates all over the world, and we compare that with the local, department store that, only serves one geographical market. Now, which one of these two investments is more risky? The online retail company, it operates on a global scale, which is a much bigger market, and therefore it has access to a much larger pool of customers. Now, this means it has a much higher chance of, first of all, surviving and then growing its business and being profitable compared to the retail store that only operates in one geographical market. So market size, it matters. It's very, very important. And simply by the nature of the United States being a large economy, US companies are operating in a big market where they have access to a huge pool of potential customers. This suggests to us that US companies, they have a better chance of surviving, a higher chance of growing and becoming profitable and staying profitable compared to companies that operate in much smaller markets. The second reason is that the United States has enjoyed long-term economic growth. If we take a look at this chart here, we see the economy of the United States since the 1960s. We can see very clearly it's in an uptrend, and that tells us that the US economy has been expanding and enjoying growth for at least the last 50 to 60 years. But we don't need this chart to tell us that, right? I mean, since the World War II period, the United States has emerged to be the dominant power in the world in terms of military, economics, and culture. And there's no reason right now to believe that this is going to change significantly anytime soon. Sure, in the short term, we do see minor contractions in the US GDP, but these happen from time to time. And as we have seen from this chart, the US economy has pretty much always recovered from this so far. What connection is there between economic growth and the stock market? If we take a look at this chart here, we will see, a big picture of US company earnings growth. We see that it's moving in tandem along with the economic growth of the United States. Long-term economic growth generally means that conditions are conducive for the companies within that economy to grow and to thrive better. It means that US companies over the years have been making and selling more products, therefore becoming more profitable over time. And as companies become more profitable, they also tend to increase in value, and that's where we see this being reflected in the stock market as well over time. Why do these conditions actually help US companies? Well, the economic system of the United States operates on free market capitalism. In order to thrive, in order to survive, businesses in the US have to find ways to make things cheaper, better, and faster, or else their customers are just going to go to their competitors. Companies that are not productive and don't innovate eventually they're going to become obsolete and irrelevant. And in the long term, this is going to be reflected in their share price as well. Whereas companies that are innovative, they allocate resources towards becoming more productive, towards providing better goods and services for their customers. These companies tend to have better earnings. And in the long term, the market rewards these companies as well. Not just for the value that they provide to their customers, but also the returns that they provide to their investors. In the past 120 years or so, we've seen rapid developments in technology that is unprecedented in history. In the early 1900s, did we have cars, airplanes that are accessible to the mass public? No, we didn't have that. Even in the early 2000s, which was really only like 20 years ago, we didn't even have things like smartphones. The development of most of these, life-changing innovations, they came out of the US. And they came out of the US because of this, this drive to succeed, this motivation to be the best, to beat out the competition and to succeed in general. I mean, that's the American dream, right? So capitalism as an economic system in the United States, it breeds innovation. And as companies are more innovative and more productive, this helps them to become more profitable, to grow larger, and we have seen how this enhances returns out of the US stock market in the long term. The next factor is that US shares tend to have high transaction volumes. Generally, there's a strong demand for US company stocks. And this is not just from individual investors like you and I. The demand for US stocks actually mainly comes from large institutions such as investment banks, hedge funds, asset managers who are building portfolios for themselves or for their ultra high net worth clients. The strong demand for US stocks means that US stocks have much higher liquidity and much higher volume of transactions. So there we have it. These are just some of the reasons, a few of the reasons why the US market has so far always recovered after a downturn and continues to grow in the long term. As long as these factors don't change drastically, we have a good reason to believe that the US stock market is going to continue on this trajectory in the long term. But of course, nobody knows the future. But I think what we have seen is that so far the US stock market has a pretty good track record. There's pretty good reason to believe that these factors are going to continue to hold. And even this recent downturn that we are experiencing, like the ones that come before it, eventually is going to pass as well. Lastly, just because these factors we have discussed today that show that the market conditions in the US makes it very conducive for businesses to thrive and to do well. That does not mean that every single company is going to do well. It does not automatically guarantee success for every single company. There are many companies in the US that don't succeed, even though the economic factors are conducive for it to do so. There's a lot of other factors involved as well. So make sure you do your research on that particular business before you make any investment. Now, knowing what we know, what am I doing about this? How am I investing in the US market? Make sure you are subscribed to find out.